Hello friends, how are you? I hope you are fine and doing well. My name is Kapish Gupta and I welcome you to my channel. As you see the title of this video, you only click this video because you really wanted to know about the investing, or maybe you are already invest your money in your any demat account. Let's go further in this video. Here in this video, what we are going to talk about is that what is investing, why we need investing, and the types of investor we have going to discuss in this video. Let's get started. What is investing? Means simple that we used to invest some little chunk of money into any bank account or in any some sort of fixed deposit, or we can say that having some kind of policies in LICs and taking some kind of endowment plan for some insurance companies and many other post office schemes also there. So these are the type of multiple schemes in which we are going to invest our money. So that is good, and these schemes are not bad for those who have little knowledge about investing and who don't take any type of bother. Just a passive investor like don't have any time to study about high return or many other policy schemes. But the thing is, these not a very good type of investment, as if we are not a very active about our money, that how our invested money is growing and what type of returns it can generate, so it is not worth for our investment. First of all, we have to check, study and watch things carefully in which we are going to invest our money. So why we need investing? The simple logic is behind that all we are going to earn money and want that our money is grow, and it can be helpful when we see our future, and at that time our money are very helpful. So that's the thing we have in our mind when we are going for investing. And generally we're going to see that the things we are facing in present, as our middle class family I'm belonging, so we don't want that our future and our old is also go for the some sort of financial bondage. So we used to be free, at least financially, when we are having the age up to 60 years. This video is very helpful to those who have the same type of goals in their mind, that they have to be a financially independent and not be any supportive to their child. This is the video which is, I think, really helpful for those people. So let's get started. So they are basically in investing, there are two type of investors in which they invest their money. The first is active and second is passive investor. So active investor, as we see the name active means who is actively participate in his investment. And there are example of these active investors are the investment they made in the stock market, and they are the multiple traders in the stock market who used to do the swing trading in their stock market. And also there are people like the fund managers who used to manage the mutual funds for the big companies and big corporations. So these types of investors are the active investors. And the other category is passive investors. Passive investors are those who used to put their money for 10 and 15 years for the long period of time, and they used to forget about their money, and their money simply grow at the rate of maybe 10 or 12% if they invest their money in any type of mutual funds, or if they're having their investment in any type of endowment plan, then they simply just grow their money with the interest rate of maybe at 6% or 7%. So passive investors are basically coming from the middle class, don't know a knowledge about the investing and other type of fields in which they are going to invest. So I think this video is also educate many of the passive investors, because the thing we forcefully invest our money in any type of endowment, LIC, post office and other type of insurances is that we don't have knowledge of the market and other type of schemes in which we are going to grow our money at the double interest rate as they are giving us. So I am also sharing of my experience and also share what I have done in current year and what I am doing in investing. I also attach my investing portfolio in this video also, and you can easily see that there is a thing that I am going to invest. So what we are going to do, what type of investor I wanted that you should be. So I don't really want that you have to be active investor. Don't be like passive investor, because passive is like lethargic and they have not grow their money at the huge amount. So I also don't want to be an active, because there are also cons in the active investor. For example, that if I am comparing one active investor who used to trade the stock market and doing the swing trading. So every time he just bought and sell any type of share, he used to pay the charges of DP, which is 20 rupees per transaction. And if he was doing the multiple transaction within a month, so he used to pay approx how many multiple transactions he was, then just multiply by 20 in each transaction. So I think the money he was used to save and the profit he was used to earn in the multiple transaction, so it can only be paid through this multiple transaction that he has having through the DP charges. So I think it is not worth for having active investor. You can also be a passive investor, but as a passive investor you have to be very careful and have a knowledge about their investing portfolio and what type of schemes you are going to invest. You have to be aware of it when you are for any type of investing. So there are the things and the skills you need to know about first, like the knowledge. First of all, you have to be you have to take a knowledge of the stock market, the mutual funds, the debt funds, the NPS, PPF funds, and pension schemes, and many type of other schemes also. And just compare and read all these type of schemes and divide the portfolio according to that, whatever the risk you are going to take. Let's take the example of mine. Like I have approx 1 lakh rupees in my saving. So I think that the risk I'm going to take is the 10% of that money. So the 1 lakh 10% is 10,000. So the 10,000 I'm going to take the risk. So what I'm going to do with 10,000 is that simply go to the stock market and open any demat account and just start trading with 10,000 rupees in my hand. And rest of the 90,000, I divide this 90,000 into some other type of investing schemes. Maybe the 70% of the 90,000 is going for equity mutual funds, which is the large cap mutual funds. And also, if you really don't want to take high risk, then go for index fund. Index fund is really good for the beginners who need to take any bother about the market, because the index funds are those which having companies of the indexes. Like there are two types of index in our Indian market, Nifty and Sensex. So the top 50 companies of the Nifty is like Reliance, Tata, HUL, Hindustan Unilever, Infosys. These type of companies are listed in the Nifty, and the Nifty are going to taking care of these type of 50 companies. If any of the company is not performing well, so Nifty just put out that company through their list and replace with the company which are going to perform very good. So these type of index funds are really good, and if you are putting your money in these type of index fund, you are going to make the money at about 12% compounded annual. So 12% is basic minimum in which the Nifty is growing throughout the 10 years when you see the chart of the Nifty. And also the same thing is going to Sensex also. Sensex is also the index which is a Bombay Stock Exchange. So these type of things are also going for same thing. So index fund are those which is good for their passive investor who go simply put their monthly SIP on the index fund, and just they can grow their money with the 12% effectively. So I think it is a very pretty and good option for those passive investors. And now as I share the 70% of my money of 90,000 I'm going to put in index fund or any large cap equity fund. And now remaining 30% of 90,000, I just divide the 30% into two categories, 20 in 10%. So the 20% of my 90,000 money I am going to put into debt. That are the safe and secure investing platform in which your money are going at less than 5 to 6%, which is equal to the bank FD's percentage, and maybe more than that. And it is useful for those who don't really want to cap their money into the bank or FD, because as we know that the inflation rises up to 6%, and the bank FDs are going to interest about 5 or 6%, so which is equal to the inflation, and I think there is no worth of using your money and while if you are not beating the inflation. So in the replacement of the bank FDs, you go for the debt fund, because debt fund are very good in place of FD. So because sometimes the bank debt funds also provide up to 7 to 8% of return if you are choosing a really good type of debt fund. If you really want to know about the debt funds, what are debt funds, tell me in the comment section. I will make the video of debt fund also, because I also invest my money in short term debt fund also. So here is the thing, and the remaining 10% of 90,000 I am going to invest in the gold. There is gold, if you having a physical then it is good, but if you're going to purchase any type of digital gold, and I'm going to tell you that it is not a good decision for you, because there are many type of expense ratio in the gold when you're going to purchase into the digital market. So if you're going to purchase the gold, just go for the sovereign gold bond, HEB bond, which is issued by the government time to time in half yearly, quarterly, monthly by the government of India or RBI. So through this type of bond, you are going to increase your money with 11.5% per annum compounded annually, and also getting dividend of 6 months regularly at the coupon rate of 6%. So if you don't know about what is the coupon rate, what is uncompounded growth annually, CAGR, and what are bonds, then you can also tell me in the comment section. I make the other video of these also, in which I'm going to discuss about CAGR, what is coupon rate, what are bonds. So these type of things I'm going to discuss. So here is the thing I explain you about the investing. Now I'm going to conclude my whole video of investing. Is simply that first of all you have to decide your portfolio, what amount of your portfolio are going to start with, and secondly you have to take the amount of risk, that what amount of risk you are going to take in your investment. So first of all you have to decide that and write it down onto the paper. Also diversify your investment on other fields also, like I explained you that approx 70% of the 70 to 75% and 20 to 25% of your investment are going for equity and bonds. Like if you having the age of 30 years or maybe less, then you should have to go for 70% equity and 30% debt and bond. But if you are going forward in the age, so these percentage are going accordingly that age also. Like for example, if you are having the age of 40 years or 50 years, like if I take the example of 50 years, then approx 50% of the money are going to be invested in equity, and rest of the 50% of your money are going to invested in any type of debt fund and the short time bond fund. So it's totally depend upon your age, because I don't really wanted that if you are going to the age of 60 and you just invested your 70% money in the equity, and if the market are going to crash and suddenly you need the money, so you can take a huge losses at that time. So I didn't really want, because the portfolio is also be rebalanced time to time. So it is really important for that also perspective also. So now what I have say I'm going to say that you need to diversify. You have to decide the portfolio amount and the amount you're going to take for the risk, and the rest of the amount you're going to diversify, whether it was in mutual funds of equity, debt funds, or taking any type of bond or gold. So these type of things in which my money is also invested, and I'm going to share my screen also how much amount I'm going to invest it in these type of other schemes and what type of portfolio I have currently. Before I'm going to wrap up this video, is that there are two qualities in which you are going to take a huge benefits when you are going for investing. Your first quality is that you need to have a discipline about your investing. Like if you are going for investment, you have to be disciplined about to have a monthly SIP of an index fund about your pocket size. Like if you are going to invest 5,000, then go for 5,000 per month. If you are going for 1,000, then go for 1,000 per month. But you need to be disciplined about the amount. It is not matter that if you don't have consistent about 1,000 or 5,000 regular. It's totally depend upon the money. Just need to know that you just go for each month. Whether if you have 1,000 rupees, go for 1,000. If you have more than 2,000, go for 2,000. At least you have to invest a single pie in each month. If you are going a harsh time and you don't have any money because the expenses of that month is really high, so just go for at least 10 rupees, because that is also important. Each single pie of your money in each month you are going to invest is really important and the building block of your investment. So I'm just going to say mutual funds are very flexible because it is not having any type of fixed amount. Just do whatever your amount you have, just go for invest that money into the mutual funds. And this is the first quality, is discipline, and second is patience. And this second quality is totally depend upon the discipline on first quality. Like if you have a patience of 10 to 15 years, then you can grow your money with the tremendous amount, and you can achieve also the return in the good form. But if you don't have any patience, then there is no use of discipline because if you're taking out the money from your investing account, then there is no future of your returns that I'm going to provide you. So just a basic calculation I'm going to share in this video at the last is that if you're going to invest 10,000 per month, you can be a crorepati or millionaire, 10 millionaire in 20 years of the investment of your 10,000 rupees. So this is the basic calculation I have done with the 12% of the rate. You can also do with the help of calculator, investing calculator and any Google. So that's enough for this video. I hope you take knowledge, and if this video is making any sense to you and you have learned some new things, then please hit the subscribe button and which is floating here. And thank you for watching me. I will see you in the next video. Bye.